In a best efforts underwriting, the underwriter makes the best effort to sell the securities at an agreed upon offering price. And it's the issuing company that has the risk of the issue not being sold. For example, the company might say, I need to sell 1,000,000 shares of stock. The underwriter says, we believe 1,000,000 shares will sell if you price them at $12, and they put them out in the open market. This offer can be pulled if there's not enough interest in the offer price, because then the company doesn't get the capital that they actually need. This is not very common because the main reason for putting stock out in the market is to raise capital for future projects and expansions. And it's not something companies do if they can't guarantee that there's going to be a return on it. The underwriter, firm commitment underwriting is safer. And then the Dutch or uniform price auction, where buyers bid a price and the number of shares that they will buy at that price. Then the seller determines the highest price at which they can sell the desired number of shares. All successful bidders pay the same price per share. And it encourages aggressive bidding or fighting among the bidders in order to buy the amount of stock that they want. So we have an example of a Dutch, or it's also called a uniform price auction, because in the end, everybody pays the same exact price, or uniform price. So we have a company that wants to sell 1,500 shares of stock. They've had 5 people bid on the number of shares that they want and the price that they will pay. So if they charge $20 a share, they're only going to sell 500 and not the full 1,500, because only one bidder has said that they're willing to pay $20 a share. So they have to go down until they can see that they can sell a full $1,500 per share. So they find that at a price of $15 per share, they can sell the full 1,500 amount off. And so A, B, C, and D get their shares, and they each pay $15 per share. A company can also do what's called a green shoe provision. A green shoe provision allows the stock to be oversubscribed. So this allows some protection while the price stabilization is happening. This is usually included in all IPO and SEO offerings, but not in debt offerings, such as the bond issue. So it can be included in all stock offerings, but it can't be included in debt issues like bonds. So this is where the syndicate is allowed to purchase an additional 15% of the issue. So if I said I wanted to sell 100 shares, they could actually purchase 115. We have a lockup agreement. Those are not legally required, but they're very common. So this restricts insiders from selling IPO shares for a specified time period, usually 180 days. The stock price tends to drop when the lockup period expires due to the market anticipation of additional shares hitting Wall Street. So this is common to what I said, where if employees or management or other people were given shares as part of some kind of bonuses or compensation, that they wouldn't be able to sell those shares for a certain number of days. IPO underpricing. So it's very, very difficult to predict what an IPO should be priced for the first time that it goes out, because there's no current market price available, and you have to guess how interested investors are going to be in this particular company. The Dutch auction is designed to help eliminate the underpricing or the amount of price change. but it often means that the issuing company gets left out of money. It's called leaving money on the table. So if a underwriter says that a stock is going to sell for $15, they give the company $15 per share, and then in a firm commitment underwriting. And then when the IPO is launched, they sell the stock and keep the difference. Well, if the stock then on the IPO sells for $40 instead of $15, that's a lot more money that company could have had for their future projects. So that's called leaving money on the table, because they missed out on their opportunity because the underwriter underpriced made an under prediction. One of the things we have is called a partial adjustment phenomenon. So during the SEC registration, a company will set a price range. So they will say, we think this price range should be between $15 and $20. Just before the IPO, the final price is determined. It can be below, inside, or above that range given during the registration period or the registration documents. All history, IPOs with a final price above the file range have been far more underpriced than those with a final price below or inside the file range. So that's just kind of this phenomenon that happens in the stock market. Researchers have still not figured out why it happens. But so if a company said they thought their file price range was $15 to $20, and then the underwriter said, no, I think $25 is better, then historically that stock would actually sell for $50 to $75. Just out of phenomenon. But if they choose something in that $15 to $20 range or under the $15 range, it's more it's going to be more stable, and there's not going to be such a huge difference between what the market ends at and what the final guess price is. So why are IPOs underpriced? There's a lot of different reasons. One, underwriters want offering to sell out, and they are incentivized because they get to keep the difference. So they're incentivized to underprice. They want everything to sell out, and they get to keep the difference. However, their reputation for a successful IPO is critical, because if they don't have a history of successful IPOs, no company is going to hire them for future IPOs. So they don't want too much underpricing, or they'll get a bad reputation from that. Underpricing is kind of insurance, though it's cushion for that offering. It allows for oversubscription and allotment. So an oversubscription is where you sell more than is available, and then in that case everybody just gets a percentage of what they tried to buy. And then there's also a winner's curse. The winner's curse is where there's an overpriced and an underpriced security, and if people put bids out, the likelihood is that the winner of the overpriced bids are going to win, where the people who bid on the underpriced are going to lose or not be able to buy as much. Part of that is because there's belief that people who really understand the market know that it's overpriced already, and so they just avoided bidding on it. Smaller, riskier IPOs are also underpriced in an effort to attract investors. So they might be purposely underpriced to attract extra investors who are willing to take on that risk. Then we have a seasoned equity offering. So this is when a new offering is put out after they already have an initial offering. So they might have 500,000 outstanding shares currently, and they decide to issue another 50,000 shares for sale. This is called a seasoned equity offering, or SEO. When we put more stock out on the market, that supply and demand thing, when we increase the supply, the price is going to decline. This can be a cause of the reason that it declines can be a variety of things. One, if management believes the equity is currently priced too high, they would choose to put more out in the market. It might also indicate that they need cash for something and they can't take any more debt on. So they could already be over leveraged and have too much debt, and the only way they can get more cash is through the issuing of stock. Now, the issue costs for issuing stock during both an IPO and an SEO are significant. It's very expensive to issue stock, and much, much more expensive than it is to issue new bonds or take out debt. So that can be concerning when they're issuing new stock. These are the different costs that companies have to pay. First is the spread. So this is the direct fees paid by the issuer to the underwriters. It's the difference between the price the issuer receives and the offer price. Other direct expenses, legal fees, filing fees for the SEC, taxes, prospectus fees, writing fees. The indirect expenses, so the amount of time that they spent working on the new issue, writing the prospectus. Abnormal returns, so this happens in a seasoned stock issue. This is when the price of the existing stock drops. On average, it's about a 3% drop, and that's called an abnormal return. Then underprices, losses arise from selling the stock below the true value, and then the green shoe option. So gives underwriters the right to buy additional shares at the offer price to cover over allotments. So let's look at some of the costs of issuing securities. So the average total direct costs are about 10.4% of the total issue. The largest direct cost is the spread. So that's about 7.2% of an issue. Direct costs are very large, especially for issues of less than $10 million. So total direct costs for issues under $10 million can be up to 25%. Normally, the underpricing cost is about 19.3%. Different things that we see in costs, and we're going to look at an example on the next slide, are economies of scale. So, obviously, the larger the issue we have, the better we're able to take costs out. Costs of selling debt are less than the cost of issuing equity. IPO costs are greater than SEO costs, and straight bonds cost less than convertible bonds. So let's look at an example. We have a company that has just gone public. They have a firm commitment agreement, so that's where they have that guaranteed price. They received $32 for each of the 4.1 million shares sold. The initial offering price was $34.40 per share. The stock rose to $41 per share in the first few minutes of trading. They paid $905,000 in legal and other direct costs and $250,000 in indirect costs. So then we have what was the flotation cost as a percentage of fund raised. Well, that's the net amount raised is the number of shares offered times the price received by the company minus the costs associated with the offer. So our net amount raised is 4.1 million shares times $32. So minus our direct and indirect costs. Then we continue this example on the next slide. So next we're going to look at the direct costs. So part of the direct costs are given in the problem, but the company also had to pay the underwriters. The stock was offered at $34.40 per share, and the company received $32 per share. The difference, which is the underwriter spread, is also a direct cost. So we paid $905,000 just in legal fees and writing fees to hire the underwriters. And then we paid the underwriters $10,745,000 as part of their issue costs. The underpricing is also in indirect costs. So our first part of our indirect costs were $250,000, and then the fact that we missed out on $6.60 times 4.1 million shares means that we had indirect costs of $27 million. So that's a lost opportunity cost if we had just offered the shares at a higher price. So our total costs were $38,055,000. So the flotation cost as a percentage of the amount raised is the total cost divided by the amount raised. So our flotation cost was 29.26%. Now, flotation is when we're talking in stock, is the cost of issuing equity for capital and getting that cash in return. We're also going to talk about float in chapter 16 and 17, and that flotation is different than stock flotation. We also know that we have multiple types of long-term debt. I know I'm over 15 minutes, but I have 2 slides left, so I'm just going to finish. So we have bonds. We've already talked about bonds in chapter 6, and we have private issue loans. We can just take loans from the bank or our insurance company with short maturities. It's easier to renegotiate loans than it is an issue of stock. Taking on debt has lower costs than public issues. We don't have to do the SEC registration. We don't have to do the underwriting. So we have those opportunities. The SEC registration, this is our shelf registration. This is an SEC rule that was very recently put into place that we talked about on our slide. This permits firms to register a large issue and sell it in small portions over a 2-year period. It gives the company more flexibility and it reduces flotation costs. However, in order to do a self-registration, the company must be rated investment grade, the market value of their stock must be higher than $150 million, they cannot have defaulted on debt within the last 3 years, and they can't have had any violations of the SEC Act of 1934 in the preceding 3 years. And that is the end of chapter 15.